this week's market update. Earnings are the main focus in a quiet week for economic data. Markets continue to focus on trade and geopolitical tensions, and Japanese growth stumbles for the first time in 2 years. With the majority of first quarter corporate results now announced in America, attention shifts across the Atlantic to Europe, where the number crunching typically takes a bit longer. Before we look at what's coming up this week, however, it's worth recapping what's been a pretty extraordinary first quarter earnings season in America. There, according to Thomson Reuters, S&P 500 companies have raised their profits by 26% on average compared with the same period in 2017. That's a stunning result, especially when you consider that we're nearly 10 years into the economic cycle. The contrast with wage growth running at just 2.6% is also remarkable. The trend of the post-financial crisis period, indeed the trend of the past 30 years or so, has been for returns to gravitate to capital, not labour, and that looks to be continuing. Another measure of this is what's happening to corporate profit margins. Here too, records are being broken. Deutsche Bank estimates that the S&P 500's average margin is now 12%. In the run-up to the crisis in 2006, it peaked at 9%. Again, this is uncharted territory. So are these kinds of profits sustainable? Clearly, profits have been given a one-off boost by the Trump tax cuts, but even adjusting for these, profits are at an all-time high. The falling dollar has also helped US exporters and overseas earners. The energy sector has benefited from the rising oil price. So what might change? Well, margins can fall either because costs rise or because prices fall. On both counts, there's little sign of things getting worse in the short term for companies or their shareholders. Wage growth remains pretty anemic, although company bosses, when asked, do seem to rank wages high on their list of worries. As for falling prices, this looks less of a problem now that deflation has been banished in the most vulnerable areas, Japan and Europe. For profits to be threatened, then, might require direct political action in response to a widening concern that ordinary workers are being left behind at the expense of capitalists and shareholders. The success of populist parties from Italy to Malaysia and the rise of harder left-wing parties like our own Labour argue that businesses are likely to come under increasing regulatory pressure, especially in key consumer-facing areas like utilities and financial services. British gas owner Centrica is just the kind of company that could find itself in politicians' sights, and the company's share price slide, it's halved in 4 years, suggests that investors are worried too. The government is talking of a price cap on the standard variable tariff that most consumers use, and doubts have been raised about the sustainability of the dividend, nominally the highest in the FTSE 100. Yesterday's results provided good news on that front. Efficiency savings and colder than normal weather mean the dividend is safe for now. Other big name results this week include EasyJet, which is expected to see a lower half-year loss on the back of higher passenger numbers. Germany's Allianz and ThyssenKrupp are both expected to comment on the strength of the euro. That's a key headwind for big companies in the region. And over in America, 2 retailers will shine some light on the Amazon effect. Home Depot is expected to benefit from the upbeat US housing market, but to have suffered from the colder than usual spring, which kept DIYers at home. Macy's, meanwhile, will report on a series of strategies to combat falling footfall in its department stores. Now, on the data front, there are 2 main highlights this week. First, and related to those corporate results, US retail sales will provide evidence from the coalface on whether the strong American jobs market and the recent tax cuts are persuading consumers to loosen the purse strings. Weaker car sales and cold weather won't have helped, but headline sales are still expected to be up 0.3% month on month. In Asia, the main focus will be on tomorrow's Japanese GDP figures, which are expected to break that country's strong run of 8 consecutive quarterly periods of economic growth. That was the longest period of continuous growth in Japan since the 1980s bubble, so it was inevitable that the good news would end at some point. Weak private consumption and dwindling appetite for exports are the culprits. The good news is that analysts think the slowdown in January to March is only a blip. With the global economy still growing, export-focused Japan is expected to renew its upward trajectory. That's good news for investors hoping that Japanese shares can finally break through the so-called iron coffin lid. That's a flat line of resistance through which the main topics index has tried and failed to break on half a dozen or so different occasions during the past 25 years since Japanese shares plunged in the early 1990s. In other markets, the oil price continues at close to multi-year highs as the political temperature in the Middle East continues to rise. Last week, it was Donald Trump's decision to ditch the Iran nuclear deal that put upward pressure on the price of crude. This week, the decision to move the US embassy from Tel Aviv to Jerusalem is the trigger for heightened tensions, which tragically have led to dozens of deaths in Palestinian areas. In that context, it almost seems tasteless to mention the price of oil, but it is the most immediate and measurable response to the worsening situation in the region. Since the end of March, the cost of crude has risen 15%, heading towards $80 a barrel and prompting talk of a return to the $100 a barrel price that prevailed before a supply glut triggered a collapse to less than $30 between 2014 and 2016. The MSCI European Energy Index, a measure of companies like Shell and Eni, is up 16% since March, outstripping even the S&P 500 Energy Index. Both have easily outpaced their respective broad equity indices over the same period. Oil companies have also benefited from a drastic reduction in costs, forced on them by recent cheap oil, which means that some producers are able to make bigger profits at $60 oil than they did when it was priced at $100. Obviously, today's significantly higher price is providing a massive windfall, and they're rewarding shareholders with revived share buyback programs. Investors in the energy sector may be beneficiaries of rising uncertainty, but the same cannot be said of emerging market investors, where talk of an imminent crisis is gaining momentum. Last week's countries in focus were Argentina and Turkey, both of which saw their currencies tumble against the dollar as fears mounted of higher US interest rates, a consequently rising dollar, and therefore a higher cost of funding debts denominated in the US currency. In Argentina, an emergency hike in the interest rate to 40% was not enough to support the beleaguered peso, and the country had to take the unpopular measure of going cap in hand to the International Monetary Fund in Washington. Argentinians have a deep-seated dislike of the IMF after its intervention in 2001 caused an economic slump and ushered in a dozen disastrous years of populist government. In Turkey, the attention is all on President Erdogan, who spooked markets yesterday when he warned that he could exert more influence on monetary policy if he's re-elected in June. He has described interest rates as the mother of all evil and promised to lower them despite the country's need to counter a flight away from the lira. That's halved over the past 5 years to a record low against the dollar. This week, Moody's stirred the emerging market pot further by warning that emerging economies with short debt maturities were highly exposed to rising interest rates. The developing world has accumulated a rapidly rising pile of debts in recent years. And meanwhile, the other big cloud hanging over markets in recent weeks, the threat of a trade war between the US and China, eased slightly over the weekend, after Donald Trump gave Chinese trade delegates to Washington an unexpected welcome present. He reversed sanctions against the Chinese telecoms group ZTE, which had almost gone out of business after being blocked from sourcing vital components from America. The threat of a trade war and the sharp fall in global economic activity it might trigger has been a key driver of the failure, against expectations, of the 10-year US Treasury yield to rise above 3% and stay there. Rising bond yields are a reflection of either fears about inflation or of optimism about the growth outlook, and the refusal of the world's benchmark bond yield to get sustainably above 3% is an indication of investor anxiety. So, the rest of 2018 looks like being more nervous than the comparable months in 2017.